Have you ever wondered why loan interest rates suddenly spike, inflation seems to rise out of nowhere, or the economy slows down unexpectedly? It's almost as if no one is steering the ship and we're all just along for the ride. But the reality is, there's a force behind these shifts. Today, we're going to uncover who's really pulling the strings and how their decisions ripple through your daily life. By the end, you'll see the economy in a whole new light. It might feel like the economy is just a collection of random events, but that's not the case. There's actually an institution with significant influence over these changes. It's not absolute control, but it's enough to shape the direction of your money, your job, and your future. Let's reveal who this is and why their actions matter so much to you. The central bank is the main player behind the scenes. Unlike regular banks, it doesn't serve customers directly. Instead, it manages the entire financial system of a country. Its main goals are to control inflation, maintain economic stability, and support growth. Think of it as the thermostat for the economy, cooling things down when inflation gets too high and heating things up when growth slows. Imagine the economy as a house. If it gets too hot, the central bank turns on the air conditioning by raising interest rates. If it gets too cold, it turns up the heat by lowering rates. This balancing act is at the heart of what the central bank does, constantly adjusting to keep things comfortable for everyone. The central bank's most powerful tool is the interest rate. By changing this rate, it can influence how much people borrow, spend, and invest. When rates are low, loans are cheaper, businesses invest more, and spending increases. When rates are high, borrowing slows, spending drops, and the economy cools down. This simple lever has a massive impact on the entire economy. When the central bank sets interest rates low, loans become more affordable. People are more likely to borrow money for homes, cars, or businesses. Companies invest in expansion, hiring, and innovation. All this activity leads to faster economic growth and more opportunities for everyone. On the flip side, when interest rates are high, loans become expensive. People borrow less, and businesses hold back on investments. Spending slows down, and the economy cools off. This is how the central bank can put the brakes on runaway inflation or overheating growth. By simply adjusting interest rates, the central bank can influence the entire economy. This power means that even if you don't pay attention to economics, the decisions made by the central bank are already affecting your life in ways you might not realize. Let's make this personal. The central bank's decisions impact your loans, savings, job prospects, and even the prices you pay for everyday goods. When interest rates are low, loans are cheaper. When rates are high, savings accounts earn more. If businesses borrow less, they may hire fewer people, and the level of inflation affects how much your money can buy. Low interest rates mean cheaper loans for buying homes, cars, or starting businesses. High interest rates mean you get better returns on your savings. These changes can influence your financial decisions, from borrowing to saving, and even planning for the future. When businesses borrow less due to high interest rates, they may hire fewer people. This can slow down job growth. At the same time, higher rates help control inflation, keeping prices from rising too quickly. Lower rates can lead to more jobs but also higher inflation. One of the central bank's biggest responsibilities is controlling inflation. If prices rise too fast, people lose purchasing power. To slow inflation, the central bank raises interest rates, which reduces spending and slows price increases. But this also means the economy can slow down, making it a delicate balancing act. Controlling inflation isn't easy. If the central bank raises rates too much, the economy can slow down, leading to fewer jobs and less growth. If it keeps rates too low, inflation can spiral out of control. This constant balancing act is at the heart of central banking. Another powerful tool the central bank uses is controlling the money supply. By increasing the amount of money in the economy, spending rises. By reducing it, spending slows. This is often done through buying or selling government bonds, which directly affects how much money is available. When the central bank buys government bonds, it injects money into the economy. This increases liquidity, making it easier for people and businesses to spend and invest. It's a way to stimulate growth when things are slow. On the other hand, when the central bank sells government bonds, it removes money from the economy. This reduces liquidity, slows spending, and helps control inflation. It's a way to cool things down when the economy is overheating. Liquidity is simply how much money is available for spending and investing. When liquidity is high, people and businesses are more active. When it's low, spending slows. The central bank's actions directly affect this balance, shaping the pace of economic activity. Let's see how these tools work in real life. Imagine inflation rises to 8%. The The central bank reacts by raising interest rates and reducing the money supply. Loans become expensive, spending decreases, and inflation starts to fall. But there's a trade-off. Economic growth slows and the job market weakens. Every action the central bank takes comes with trade-offs. Controlling inflation can mean slower growth and fewer jobs. Stimulating growth can lead to higher inflation. Understanding these trade-offs helps you see why economic cycles happen and why things don't stay the same forever. So why should you care? Because the central bank's decisions affect your finances, your job, and your future. By understanding how these cycles work, you can plan better and be prepared for changes. Whether you like it or not, you're part of this system. Economic cycles are natural. Sometimes things are booming, sometimes they slow down. The central bank's actions are a big reason why these cycles happen. By watching interest rates and money supply, you can anticipate changes and make smarter decisions. Interest rates affect everything from mortgages to credit cards to savings accounts. By understanding how the central bank operates, you can make better choices about borrowing, saving, and investing. This knowledge helps you stay ahead of changes and protect your financial future. The economy is always shifting. Sometimes rates go up, sometimes they go down. Being prepared means you're ready to adapt, whether it's finding a new job, adjusting your budget, or rethinking your investments. The central bank's moves are signals you can use. No matter your job or lifestyle, you're affected by the central bank's decisions. From the price of groceries to the interest on your loans, everything is connected. Understanding this system helps you make sense of the changes you see around you. The economy doesn't just move randomly. There are forces guiding it, and central banks play a major role. While they can't control everything, their influence is significant. The more you understand this, the better decisions you can make for yourself and your family. Central banks don't have absolute power. They can't fix every problem or predict every crisis. But their actions set the tone for the economy, and their decisions are among the most important factors shaping your financial world. When you understand how central banks operate, you can make smarter choices about borrowing, saving, and investing. This knowledge gives you an edge, helping you navigate economic ups and downs with confidence. Interest rates don't just affect big businesses, they impact everyone. From the cost of your mortgage to the interest on your credit card, these changes ripple through the economy and touch every aspect of your financial life. Inflation affects your purchasing power. When prices rise quickly, your money buys less. Central banks work to keep inflation in check, but their actions can also slow the economy. It's a constant struggle to balance growth and stability. The money supply is the total amount of money circulating in the economy. Central banks can increase or decrease this supply to influence spending and investment. More money means more activity. Less money means things slow down. Buying and selling government bonds is a key way central banks manage the money supply. When they buy bonds, they inject money into the system. When they sell bonds, they pull money out. This process helps control liquidity and keeps the economy balanced. Liquidity is crucial for a healthy economy. When there's plenty of money available, people spend and invest more. When liquidity is tight, spending slows and businesses may struggle. Central banks monitor and adjust liquidity to keep things moving smoothly. Imagine inflation suddenly jumps to 8%. The central bank steps in, raising interest rates and reducing the money supply. Loans become more expensive, spending drops, and inflation starts to fall. But this also means slower growth and fewer jobs, a classic trade-off. Every central bank decision comes with trade-offs. Raising rates can control inflation but slow growth. Lowering rates can boost growth but risk higher inflation. Understanding these trade-offs helps you see why economic changes happen. Economic cycles are a normal part of life. Sometimes things are booming, sometimes they slow down. Central banks play a big role in these cycles, using their tools to keep things balanced. By understanding this, you can plan and adapt more effectively. Interest rates and money supply changes affect your financial plans. Whether you're saving for a home, planning a career move, or investing for retirement, knowing how central banks operate gives you an advantage. Stay informed and be ready for shifts. The economy is always changing. Sometimes rates rise, sometimes they fall. Being adaptable means you're ready for whatever comes next, whether it's a new job, a change in spending habits, or a shift in investments. Central banks are the guiding force behind many economic changes. Their decisions shape the direction of the economy, affecting everything from jobs to prices to investments. Understanding their role helps you make sense of the world around you. Central banks don't control everything. They can't predict every crisis or fix every problem, but their influence is strong and their actions set the tone for the economy. By understanding this, you can make more informed decisions. Knowledge is power. When you understand how central banks operate, you can make better choices about borrowing, saving, and investing. This helps you navigate economic ups and downs and protect your financial future. The economy isn't just numbers on a screen, it's your life. From the job you have to the prices you pay, everything is connected. Central banks play a major role in shaping this reality, and understanding their actions helps you take control. To recap, central banks use tools like interest rates and money supply to guide the economy. Their actions affect loans, savings, jobs, and prices. Every decision comes with trade-offs, and understanding these helps you plan and adapt. The more you understand central banks, the better you can manage your finances and prepare for changes. Stay informed, plan ahead, and remember that you're part of a system that affects everyone. Once you understand how central banks operate, you'll start seeing the economy in a whole new way. You'll notice the signals, anticipate changes, and make smarter decisions. This knowledge empowers you to take control of your financial future. Remember, the economy isn't just a collection of numbers, it's your life. Central banks play a major role in shaping this reality. By understanding their actions, you can make better decisions, adapt to changes, and take charge of your financial destiny.